Hey everybody, welcome to Mortgage Today for Thursday, October 5th, 2023, and oh, what a day it was. MBS were up 13 basis points bright and early this morning, which was a nice change of pace. S&P futures were also up about 3.5 points, though they were losing ground after another better than expected jobless claims in the morning at that point, which was just feeding into the higher for longer repricing phase of things. Jobless claims came in at 207,000 on a 210 forecast. It was 205 previously. Continuing claims fell 1,000 to 1.664 million. Challenger job reports came in with 47,457 job cuts, down 37% from August, up 58% from last year, mostly led by tech and retail. More and more mortgage applications are being rejected for insufficient income as mortgage payments rise faster than incomes. The CFPB reported that the average monthly mortgage payment at the end of 2022 was $2,045 compared to $1,400 the year before. This is a 46% increase in payment, and incomes are rising in the mid-single digits. Tomorrow we are going to get the BLS jobs report. The market is expecting 170,000 reading. It was 187,000 previously. BLS, interestingly, does not count people on strike, so that's interesting. Also, multiple job holders on the rise. Over the last year, there have been 3 million jobs created, but 500,000 of those are multiple job holders, so kind of double counting. While bonds definitely had a logical reaction to this morning's stronger jobless claims data at first, a less logical rally followed shortly thereafter. By the time we zoom out and consider the week as a whole, we see a gradual downtrend in yields leading back from Tuesday's highs, with brief departures to react to economic reports. In other words, there is a big picture strategic circling of wagons ahead of the jobs report. The best thing you could say about it is that it indicates that bonds can be receptive to stronger or weaker data. MBS closed up 13 basis points, which is 20 basis points higher than the worst point of the day, closing at 97.95. So at 97.95, right underneath that R1 Fibonacci line that we butted up against a couple of times and couldn't really break through. Also interesting story here from Hammer Helmer over at Originator Success. Smarter folks than me have pointed out that the government is 43% larger than it was 4 years ago, and there has been a huge increase in government subsidies, credits, and handouts that are driving the economy. The coming supply of treasuries required to fund this government, that's right, it's not your taxes that funded its debt, will demand higher yields until something breaks in the economy. Also contributing to a drop in demand is the fact that 4 of the largest purchasers of Treasury debt have pulled back. The Fed bought about a quarter of all Treasury debt in the past decade, but they are shrinking their balance sheet. China's playing political games, and they're running out of money because they are facing a housing crisis themselves. Japan is buying closer to home. And lastly, banks are no longer keen to load up on risk-free long-dated Treasury bonds that have proved to be more risky than expected in the banking debacle back in March. So, worst case scenario of all 4 of those.